Imagine you've pitched your startup idea to a VC. You're passionate, confident, maybe even a little cocky, and then they hit you with this one brutal line. This isn't a venture scalable business. What does that even mean? You've got traction, you've got revenue, you've got a waitlist, but they walk away. Today, I'm going to break down exactly what a venture scalable startup is, why most founders get this wrong, and how you can build one that actually gets funded. If you're here to learn how to impress VCs, avoid wasting 2 years on a business that will never scale, or just understand the game behind the game, watch this video till the end. I'm going to walk you through the anatomy of a venture scale startup, tell you why 95% plus of businesses aren't VC fundable, and pull back the curtain of how Silicon Valley and how tech funded VCs really think. So let's get into it. Quick gut check. If your startup doubled in customers tomorrow, would it break or scale? This question might be the line between a lifestyle business and a billion-dollar rocket ship. So let's unpack the details. Now, point number one, what VCs actually want. Venture capital is in charity. VCs want 10x to 100x plus returns depending on their fund size. Not from every bet, but from the few winners in their portfolio. So, they invest in businesses with the potential to return hundreds of millions or maybe even billions of dollars. That means they need companies which have massive margins, strong markets, tremendous market size of over $1 billion, network effects, or exponential growth levers. Not just code ideas, but actual scalable systems. Point number two, the scalability trap. A common mistake which most founders make. The founders confuse growth with scale. A coding bootcamp or a small edtech company making $500K a year is great, but it doesn't scale without more instructors, more locations, and more headaches. You contrast that with Duolingo. One app, infinite users. Costs barely go up as users explode. Now that's scalable. Growth is just increase in revenue. That means growth may be fast, it may be slow, but essentially it's just about growth in revenue. Whereas scale means implementing systems in the company which can effectively sustain the fast growth. You have growth systems, customer support systems, hiring systems, operation systems, and many more. The twist, most funds reject 90% of the startups because they are really just high effort jobs with fast growth, but essentially they lack systems in place. Point number three, market size misconceptions. This is another trap which most founders face. Founders build products for very niche markets. We are the Zepto for electronic appliances in Mumbai. Cool idea. But if your total addressable market is less than $1 billion, it's a pass. Don't confuse the entire electronics market as your TAM. In this case, if you think your TAM is the people who want their electronics in 10 minutes, you're wrong. Your TAM is the top 10 or to 20% of the gross margins of the people who want electronics within 10 minutes within Mumbai. Suddenly, the market doesn't look too big, does it? Here's the controversy. VCs will take a bad idea in a huge market over a great idea in a tiny one. Why? Because the market gives you room to pivot. Ideas change, startups pivot, markets don't. Point number four, the unfair advantage. The best venture scale startups have what insiders call a moat. I'm sure you must have heard a lot of investors, VCs asking you, what is the moat of your business? Now, it could be tech, which no one else could build, something like an OpenAI, which has very proprietary tech. It could be network effects, something like social networks like LinkedIn, Facebook, Instagram, YouTube, or something like Airbnb. Or it could be a distribution edge, like Mr. Beast launching a burger chain to its 100 million followers. Or it could be excellence in execution, which comes with decades of industry experience, network, and connections. If your business grows and competitors can easily copy you, you're just doing free R&D for someone who's more richer than you or has access to more funds. So real talk, pause and ask yourself, If a VC handed me $5 million right now, could I spend it to grow fast without burning everything down? If the answer is no, you're not venture scalable yet. Let me tell you a quick story about a close friend and a startup founder I know. A founder I know once built a brilliant enterprise SaaS product. Decades of deep industry expertise, working with some of the largest global leaders in the space, had tremendous existing network, clear value proposition, price was cheaper than the existing large MNC players were already offering that market, and the founder had built solid revenue. But every sale needed a 30-minute demo with months of negotiations to close the enterprise deal, on an average 3 to 4 months. So VCs told him, this is a consulting business in disguise. It's not a VC scalable business. He was heartbroken, but he listened. He built his business without VC money. And what's the result, you ask? His sign-ups went up 5 times. His sales team was built from scratch. He built his SDR team and his closer team. And he's aiming to hit $1 million this year, completely bootstrapped. Now that's the pivot from hard work to smart scale. So here's the final truth. Not every business needs funding, VC funding, and that's okay. Just like the friend's example which I gave you earlier. But if you're chasing venture capital, you better be building for speed, scale, and growth spikes, or which is also known as the hockey stick growth. Build something that can grow without linear effort. It needs to have exponential growth factors, only then the VCs would be interested. You need to have a clear edge, and you need to solve a problem for millions, not thousands. If you get that right, VCs won't just listen, they would chase you. If you got value from this breakdown, share this with a founder who needs a wake-up call and subscribe to my channel. And if you're serious about building something venture scalable, check out my previous video on the left here. See you in the next one.